It is a gigantic week for semiconductor stocks as the biggest of them all, Nvidia, reports their earnings this week. We'll give you a preview of what to expect when Nvidia reports their earnings. We'll also talk about another company that used to be the biggest and baddest semiconductor company. That, of course, is Intel. Is there a possibility that Intel actually goes bankrupt? Their debt downgraded this week, essentially to junk status. We'll take a look at Intel's financials and their plan to turn things around. AMD made a large acquisition. We'll talk about that. And Applied Materials also reported earnings. We'll go through those on today's show, give you a look inside of the company that maybe a lot of you haven't taken a close look at. And then obviously we will look at all of these stocks from a technical perspective as well. They've bounced back over the past couple of weeks, and we'll see if Nvidia's earnings can move these things even higher. What is going on, investors? Hopefully you guys are doing well out there. Welcome to our new channel, Equity Empire. We're officially launching later this week. We'll have newsletters and other things to announce later in the week, but got a lot of news to talk about. We got to kick things off with Nvidia, which have really kicked things off over the last year. Shares of Nvidia up over 180%, even year to date up 161%. Yeah, you could have bought this one in January and you'd be up 161%, even 6 months ago, well after the AI trade was well known, up 64%. So the question is, can Nvidia continue this type of performance? Because we're pushing over a $3 trillion market cap. We're obviously getting into the biggest of the biggest companies. If this company goes up another 160% over the next year, this is by far the biggest company in the world. In fact, it would be worth maybe like 2 or 3 Amazons at that point. So can Nvidia do that? Can it keep that momentum going? Well, we'll get some clues. The company reports their earnings on Wednesday, August 28th. Now, the expectations, I think, for Nvidia are too low. Expectations are for just $28.7 billion. I'll show you in a minute why I think those expectations are a little bit low based on the revenue trajectory that this company has been on really since the past year. Now, the high-end estimate, though, is closer to $30.5 billion, which is where Nvidia has been falling over the past several quarters. Now, more importantly than the current quarter guidance, although I will tell you, if Nvidia comes even just slightly underneath or meeting the revenue estimate of $28 billion, shares will probably not like that, given that the upcoming quarter in Q3, we're expecting $31.7 billion. Nvidia, as most of you know, have been just smashing estimates. They've been smashing the revenue estimate in the current quarter, and then they smashed the revenue estimate, and I think even a year ago, they beat it by over $10 billion. I'm not expecting that type of jump, but I'm expecting the revenue estimate for the upcoming quarter, that would be the Q3, fiscal Q3 for Nvidia, to be well north of, I would say, 32, 33, probably even potentially $34 billion. So Wall Street expectations, I think, are still low. I think you can start looking to these high-end estimates, $36 billion, probably maybe slightly more rosy than I would have, but I think this company is going to put up $33, $34 billion in Q3. They're going to be much closer to $30 billion in this quarter. Now, I tell you what, the Wall Street has just been trying to catch up with this company from a revenue perspective. Believe it or not, this time a year ago, the expectations for revenue in the upcoming quarter that will be announced on Wednesday was for just $19.69 billion. That's right. Wall Street a year ago, even after we had known the explosive growth this company was likely to experience, revenue is expected to only be $20 billion. Now the expectations are for $28 billion. And I want to show you that I think this is probably a little bit low. If we look at the company's quarterly revenue trend, this gives you a quarter over quarter view of the company's revenue. And you'll see ever since kind of the AI data center boom started happening right in Q2 of last year, we've been consistently adding about $4 billion worth of additional revenue to the data center quarter over quarter over quarter over quarter. And it's translated down into their total revenue as their gaming and their professional software and their automobile business. While these have certainly grown over the past year, they certainly haven't added from a revenue perspective as much as the data center, but those business lines are holding up. And we got to imagine, which we'll talk about here in a moment, that these large cap companies like Amazon, like Google, like Microsoft, they've all reported earnings over the past couple of weeks, and none of them, absolutely none of them, gave any indication that there was going to be a slowdown in data center spending. In fact, most of them, including Meta, said you will have a significant increase in data spending. Now, look at your total revenues over in Nvidia quarter over quarter. We went from 13.5 up to 18. So that's like over $4 billion worth of revenue jump. Then we went from Q3 to Q4, where we went from 18 to 22. That's also $4 billion jump. Now, from Q4 to Q1, it's slightly under. It's like 3.9 billion, but we'll give them credit. About $4 billion jump. That's why I'm looking at the upcoming quarter, where Nvidia is projected, and I hesitate to say this, but do just $28.7 billion of revenue. That would be just a $2 billion jump over the previous quarter, and nothing that we've seen from these mega cap companies. Again, the customers from Nvidia are not you and I. They are the mega cap companies, which have tens of billions of dollars, in some cases like Google, $100 billion in cash. You're looking at Meta, which is wildly profitable. They have billions and billions of dollars to spend on these data center GPUs. They just reported earnings. They just had conference calls. Nobody was saying that they've slowed down. In fact, they're knocking on the door, beating down the door of Nvidia, waiting for their products. I don't think that we're going to only add $2 billion quarter over quarter of revenue. I think it's going to be closer to $4 billion. That's why I think we print a quarter closer to $30 billion, or the high-end estimate, and that's why I think Nvidia also guides for the upcoming quarter, instead of $32 billion, it'll probably be closer to $33 or $34 billion. I'd actually be surprised if it was $36 billion, but if Nvidia does that, then the all-time highs of a split-adjusted price of $140 certainly will become a reality. Now, aside from the revenue figures, which I believe, again, as I outlined, are a little bit low, and the expectations will likely continue to be driven up over at Nvidia over the next couple quarters, because if Q3 is going to come in at $32 to $34 billion, well, certainly Q4 is going to be higher than 34, and as we get into Q1, Q2 of next year, we're certainly going to be approaching $40 billion much faster than Wall Street expectations currently are. Now, will this drive the stock higher? Will it drive it lower? Probably depends on a couple of factors, and one of those factors is going to be the Blackwell release, which we outlined on a previous show that has been delayed by Nvidia. We were expecting maybe some small amount of production to make its way into the marketplace Q3, Q4, back half of this year. It certainly looks like, after hearing from Supermicro, which is obviously a big customer from Nvidia as well, they said that they're not expecting that product to be released until the first half of 2025, calendar year 2025. So the question that Nvidia is going to get a lot on their conference call is a little bit more insight, a little bit more clarity, because Nvidia is probably not confident as we sit today that they're going to be able to deliver that product in Q1. Obviously, semiconductors goes without saying, very complex product, very complex from a manufacturing perspective. But if they get on the conference call and give a lot of confidence and say, hey, this was just a minor thing, we just wanted to make this thing perfect, and they're very firm on it shipping out in the first half or first quarter of next year, well, yeah, these revenue estimates that are going to be for the first half of the year absolutely going to get driven higher as well, probably be positive, and it's seen as a positive for the stock as well. We'll look at Nvidia later in the show. There's always timestamps down below. We'll look at it technically as well, as the price action in this one as we head into earnings certainly will be interesting. Now, some of the other discussion that we've had around AI is you're looking at later this week, we'll hear from Salesforce. In fact, I think on Wednesday, Salesforce, ticker symbol CRM, they report their earnings. We've seen some other companies report, like ServiceNow didn't really blow the doors off of people. Other companies that were expecting maybe a lot of this AI revenue, even when you looked at Microsoft, it wasn't like this exponential growth on the revenue side of AI software, but Microsoft is seeing exponential growth on the server side. The Azure server side is certainly bringing in a lot more revenue as there's a lot of startups and a lot of companies that are using that server power to try to build new AI services and software. But one of the criticism people have is, hey, well, where are all these, major services? Some people are even comparing AI to .com, where you had all these websites and these .com things. They emerged during the .com era, but none of them really made any revenue until after a little while. Obviously, .com played out beautifully, but there was kind of this boom and bust cycle of the .com era. Many people thinking we're kind of in a boom and bust cycle of AI. These companies like Amazon and Google and Microsoft are spending tens of billions of dollars every 3 months on their AI data centers. And a lot of people are looking for, where's the tens of billions of dollars of additional revenue coming from products? Well, Andy Jassy, I think not intentionally, but Andy Jassy actually maybe kind of explaining maybe what's going to be more of the backbone around AI, at least in the shorter term, is actually a lot of efficiencies. In a LinkedIn post, which I'm sure everybody's just glued to LinkedIn these days, he says, one of the most tedious but critical tasks for software development teams is updating foundational software. So he says it's not new feature work. It's not something that you see on the Amazon app or even on the Amazon website or anything like that. So it's, as he says here, it's work that's either kind of dreaded or put off for more exciting work. But what the company is noticing is their Amazon Q, which is some generative AI assistant for software development internally at Amazon, it's having a massive effect on the company. He says the average time to upgrade an application to Java 17, essentially a software application, plummeted. So the average time to upgrade an application plummeted, which is really good from a development perspective. He says it's typically 50 developer days to just a few hours. So they've gone from 50 days, which is like a month and a half, to just a few hours. And we've estimated that this saved us the equivalent of 4,500 developer years of work. He says that's a crazy number. In just under 6 months, we've been able to upgrade more than 50% of our production Java systems to modernize the versions at a fraction of the usual time and effort. Said the developers shipped 79% of auto-generated code. That's a nightmare if you have a computer science and computer coding degree, as much less computer designers are going to be needed, computer coders, if you will. They're going to be needed in the future because a lot of this code is going to be auto-generated. So 1 to a team of 10, 15 coders are going to be able to do the job previously of hundreds or thousands. And here's the really interesting stat. He's saying that the upgrades have enhanced security and reduced infrastructure costs, providing an estimated $260 million in annualized efficiency gains. So the company is saving time with developers. They certainly don't need as many developers. They're updating their software, which means there's going to be less security issues and potentially problems, and they're saving lots and lots of money. So the big companies like Amazon, they're going to be able to roll this out. The Microsofts, they're going to create white papers and LinkedIn posts on these types of things. And this will just continue to trickle down to other companies. In fact, we'll talk about a company here later today. We'll talk about Intel, how they are looking to reduce their costs. I don't know if they're going to be able to apply AI and other types of software in order to do it, but a lot of companies are going to want to do this. And here is the big benefit of AI, at least in the shorter term. It's not sexy new products like ChatGPT or Midjourney or anything like that. It's these back-end tedious tasks that used to take lots of time, lots of developers, and millions and hundreds of millions of dollars. Well, that is all being shrunk, and it's allowing Amazon to save a lot of money, and I bet a lot of other companies as well. Now, speaking of saving money, a company that's going to need to do that, and we'll outline their plan today, is Intel Corporation. Over the past 6 months, shares of Intel have not done well, down 52%. Year to date, down 59%. Over the past month, you're down 37%. Sadly, no matter what time frame you're looking at Intel, other than maybe the last day, you're up 2%. But over the past 5 days, you're down 2.6%. You're hovering right at that $20 mark, right close to 52-week lows on this one at about $18. Can Intel turn things around? That is the question everybody is asking, and that is the question that rating agencies are asking as well. So despite Intel getting billions and billions of dollars from the United States taxpayer, the company still has a lot of bank-owned debt as well, and credit agency S&P said, well, we're going to lower your debt rating to BBB+. This is going to be a problem. Even when you have a lowering interest rate environment, a company like this might have to retap the debt markets. And obviously, when your credit rating, this is basically like your credit score. If you don't know what BBB plus is, it's essentially going from maybe a high quality credit score, not a perfect credit score, but now you're kind of in that middle tier. When you go apply for a car loan or a home loan, you're obviously not getting the prime rate or the lowest rate. Intel obviously not going to get that as well. So what the company is doing is something it probably should have done several years ago. And the signs were there. When we go through Intel's financials, I will show you, and we've done this numerous times on the main channel, where I've showed, and this is like years ago, I showed you, this company was in deep financial trouble. And so it doesn't give me a lot of confidence that they are just now meeting these challenges today, when 2 or 3 years ago, these challenges were staring them at the face. But I tell you what, better late than never for Intel, as they plan to reduce cost in their sales and marketing division by about 35%. Now, their sales and marketing division is broken out on their financials. Here's your marketing, general, and administrative, although this includes general and administrative. So this $1.3 billion, which appears to be kind of we'll assume it's kind of an annualized number that this company is on. Every 3 months, they realize about $1.3 billion in cost. This is marketing, general, administrative. We'll assume they can shave maybe 25 to 30% off of this number, which would be on the high end, I think close to $400 million. Take a look that it would put only a small dent in their operating income loss, which in the most recent quarter came in at about $1.9 billion. Even when you rewind time to last year, when margins were a little bit higher and costs weren't exactly as high as they were, you still lost $1 billion on a quarterly basis. Now, if you subtract $400 million from that, either of these two numbers, you're still generating an operating loss on a quarterly basis for Intel. Some of you might point out that there are some restructuring and other charges. These are not related to the business. Those are baked into these costs as well. Those we would expect if you lay off 35% of your marketing division. Well, those costs are going to continue to reoccur as you have to continue to pay severance costs and those types of things. So if we just use the most recent quarter as an example, if we add back in 943, we're at $1 billion loss. If we take off 30 to 40% of this marketing budget, we're still at a loss of about $500 million on a quarterly basis for Intel. And this is also before they have to pay interest on their debt, which is not a small number. It was $224 million last year. This year, closer to $80 million. But you get a drop in interest rate, all of a sudden these companies that are just marginally profitable, maybe marginally making a little bit of money on the cash that they have in their balance sheet, well, that goes to zero, and you still have to pay that interest rate on that long-term debt. This company has got a long ways before it gets to any type of profitability. And that's a problem when you've got companies like Nvidia, which are just absolutely crushing it, needless to say. Now, the company has a lot of goals. And I tell you what, again, these should have been set out years and years ago, reducing their operation costs, simplifying their portfolio. My God, you look at the product tree of Intel, and it takes like a PhD in computer science to even know what's going on there. Eliminating complexity, same thing, goes along with their product grid. They have like a million different SKUs over at Intel. It's just ridiculous. Whereas you look at Nvidia, there's like H100, you know what I mean? H200. Like there's not that much complexity when you look at Nvidia's product categories versus Intel's. You're reducing your capital cost. Obviously, they've got to do that. Suspending their dividend, they did that already. And maintaining investments in growth areas, they're not going to be able to do this. And you have to have confidence in Pat Gelsinger. And he's been there a while. In the early days, I was calling for him to get fired or replaced, and people were like, well, he just got there, and he's going to turn things around. Well, here we are a couple of years later, and he hasn't. And he said more recently, our annual revenue in 2020 was about $24 billion higher. Get that? Can you believe that? Just 4 years ago, annual revenue at Intel was $24 billion, not $24 billion. It was $24 billion higher than it was last year, yet our current workforce is actually 10% larger now than it was then. There's a lot of reasons for this, but it's not sustainable path forward. He should have made these changes years ago, right when he was installed as CEO. He sat on his ass, thought things would just get better magically, and now they haven't. Now he has to turn things around. I don't think he's the guy for the job. I think these shares continue to move lower, or at the very least hover at this $20 level. There's other semiconductor makers and manufacturers, and even a broad-based ETF that's going to outperform this company. One of those companies that will probably outperform is AMD, but combined, Intel and AMD shipping more CPUs, which is the central processing unit found in basically all of your Windows-based PCs in Q2, despite overfill. So there's an interesting quote in here, and they said that Intel's guidance, this was based on their last earnings report, suggested an overfilled CPU channel was impacting their second half outlook. So second half outlook for Intel was a disaster. Like, it was well below expectations. So the expectations for Intel's current quarter were really, really bad. This was back in early August when the company reported their earnings. The current quarter was really bad, but what really sent the stock down lower was the outlook was really bad. And what Bernstein is saying is that they overfilled, or they're shoving PCs and CPUs into the market. And part of this is a strategy from Intel in that they know every CPU that they don't ship means that AMD probably gets that business. And so what both of these companies have seen is a shrinking of their margins in the PC business. They still generate pretty decent revenue, but particularly when we looked at AMD, their margins in that business have completely shriveled up. So these companies are basically just giving away these CPUs at a very, very thin margin. Now, AMD can absolutely afford to play this game, and I think AMD is actually being smart. They're playing that game with Intel. They're keeping margins relatively small. AMD has other business lines, including their AI and their embedded business, which prints enough operating profits to, at the very least, appease shareholders and hold shares in that $150 range. The analyst noted that Intel has been pulling forward sales for quite a few quarters, with recent incentivized sales levels approaching the elevated levels we saw in 2022, and hence they are paying for it now. So Intel has been incentivizing people to actually buy these CPUs, giving them great deals, great terms on the purchases, and it's obviously hurt Intel's financial reports and their financials. It's hurt their stock, and AMD is happy to play that game because they look at the same financial sheets that you and I do, and they say, wow, if this company plays that game for another couple years and some of their other business lines don't turn around, well, this credit rating is going to go from BBB plus to DDD minus, and this company, as I contend, could potentially go bankrupt. Now, AMD not going bankrupt. They're playing offense as they acquire ZT Systems in a $4.9 billion. It was a cash and stock deal. We don't get the breakdown of cash and stock. Maybe we'll certainly see it when AMD reports their earnings after this closes. Maybe this closes right away, but you'll see it on their cash flow statement, on their it's kind of an acquisition line in the investment activities. And we'll see how much cash they actually had to outlay for this. But they did say it was interesting that they said that the earnings would be accretive to kind of a non-GAAP perspective. So my guess is that ZT Systems, a company that makes custom servers and other types of solutions for hyperscalers and very specific customers, my guess is this company is marginally profitable. Since it was a private company, they have employees, they have other things to pay for. My guess is they were probably marginally profitable. You roll them over into AMD. You don't need 2 accountants and 2 legal teams and 2 marketing teams. And so there's going to be some efficiencies there. And this company will contribute, at least probably in a very small way, to AMD's profits. Now, this is going to be a story that accelerates as we move into next year, as we continue to see advancements in the capability of these AI systems. This is probably something that's going to take the Blackwell design, more direct liquid cooling or DLC, onto these racks to allow these servers to run even more efficiently and run more software. These humanoid robots, which I have been talking about, is the virgin snow. We talked about earlier, how Andy Jassy's talking about $240 million in savings, but it's not a flashy new product. It's not something that's necessarily going to drive the stock, at least in the shorter term, although Amazon continues to do this on the back end. When you open up Amazon's quarterly results, a company that is profitable, much more profitable than they were even like 2 years ago, you're going to notice $240 million, believe it or not, on Amazon's financials, particularly if they roll this out to other software systems. But what could drive Amazon from like a $1 or $2 trillion business up to $4 or $5 trillion business? Well, yeah, you guessed it. It's replacing some of that human labor or augmenting some of that human labor, as some people are just so scared of people losing jobs, especially entry-level ones. Well, these humanoid robots certainly could change the financial status of a lot of companies, could unlock a lot of business models as well from a delivery perspective, certainly in the warehouse and in those factories. I've contended this is probably one of the biggest opportunities in AI, as software is such a competitive space, and that you have maybe one company doing basically the same thing as other. I mean, how many chatbots do we have at this point in LLMs? You have companies like Meta, which basically develop these things and give them away for free. So it's difficult to understand the business model. Tesla had a job posting more recently. I tell you what, if you live in Texas and you want this job, you will get $48 an hour. You are required to walk for about 7 hours a day while carrying up to 30 pounds. And you need to be about 5'8". If you are 5'8" and you want to walk 7 hours a day and carry up to 30 pounds, you will earn $48 an hour at Tesla, as they are testing humans to move around in a factory to train an AI robot. And so I tell you what, Tesla, Amazon, Walmart, many other companies will benefit from this. I think we're seeing the early innings of this now. I think we'll be in the mid innings by next year. I think this is something that's going to accelerate much faster than people realize. Now, we had earnings this week, and we had Applied Materials, ticker symbol AMAT. Company reported their earnings early last week. My apologies, we skipped last week's show. It was basically a travel day for me, and after I looked at the news flow, I decided to just condense everything into this week's show. Over the past month, shares of AMAT, up, down 1%. 6 months, it's been decent, but year to date, you're up 25% over the past year. Tell you what, you're up 36%. Can the company continue to things go in this direction? Well, Q3 revenues were really nice. $6.8 billion in revenue. That was 5.4% year-over-year growth. Not one of these explosive growth companies, but they beat expectations. And when we come over here and look at this financially, they're doing a really good job. This is why Intel is so offensive, because you look at these other semiconductor related companies and they just have controlled their costs really nicely over the past year. Guidance also coming in at about $6.9 billion, plus or minus $400 million. So you certainly could top into that $7.172, $7.3 billion in revenue. The expectation came in at about 6.9. So basically kind of a meet and maybe a slight raise on the quarter, certainly beneficial for the shareholders. You have that $6.8 billion in revenue, 3.2 in gross profit. Look at this company, how they've just controlled their operating expenses. This is what you want to see. And this is why when you see other companies, and I hate to keep going back to it, but when you see an Intel where it's just offensively unprofitable, that should be a major, major red flag for you. Look at the 9 months ended over the past year, 3.5 up to 3.7 on the operating expenses. Some companies are actually driving this down. This company not able to do that, but it's offset again by higher revenue, higher gross profits. And so your income from operations down here over the last 9 months went from 5.7 up to 5.8. If you look at it on a quarterly basis, from 1.8 up to 1.9. You want to focus on income from operations. You get down here to interest expense and income taxes. We'll see that from this company from a cash flow perspective. This is stuff that can bounce around. Depends on who's president. Depends on when you have to pay those income taxes. Depends on interest rates as well. I tend to focus on these income from operations because all things being equal, the company could figure out income taxes and all that other stuff. But if you're negative operating the business, you've got a big business problem. If you're a negative net income because you have some interest to pay on your debt or you had higher than expected income taxes, well, we can figure that out later. But if you're negative from operating the business perspective, that's a huge red flag. AMAT doing a very nice job, not a fast grower from a revenue perspective, but they've got all of these costs, R&D, marketing, general administrative, they've got these all in check. and things are looking really, really good. They've got plenty of cash on their balance sheet as well. Inventory year over year is not dramatically going up, showing that they've gotten a sell-through on their products. They carry a little bit of long-term debt here, but for the most part, it's balanced out. In fact, it is balanced out largely by cash. From a cash flow perspective, we saw some leakage year over year, at least on a quarterly basis, even year over year on a 9-month basis. We have a decline in operating cash flow. I think most of that, it appears, has to do with deferred income taxes. So it looks like they had to defer a slightly more income taxes, which reduce their operating cash flow. Not a big capital intensive business over here. They're not building a foundry. They're not doing crazy stuff that just simply hasn't been done in years in the semiconductor business. Capital expenditures very low. Purchase of investments also relatively low compared to the operating cash flow. So it gives the company the room to do a couple of things. Common stock repurchases in the quarter, $861 over the last 9 months. $2.4 billion, and they're also paying you a dividend on this one, and the dividend yield currently sitting under 1%, so there's certainly some room for growth there as well, as the company has an excess amount of cash even after doing all of this, the investments, even the slightly decreased operating cash flow. They increased their cash year over year, although some of it does have to do with the fact that they did borrow just a little bit of money. Even if you strip that out, this company has room to continue to increase the dividend if it wanted to. Now, the risk with AMAT is the fact that China is a big customer of theirs. Now, we don't have necessarily a problem with China over here at Equity Empire, but you have to look at it from a geopolitical standpoint, and we've got two candidates where I would say, I think most people look at the two candidates, and unfortunately with the United States and China, you have to kind of venture into politics a little bit. It's difficult to really know. The current President Joe Biden, has been way more of a hawk on China, or put another way, very tough on China. And it's very one-dimensional as well. With former President Trump, who obviously preceded President Joe Biden, you kind of got the sense that Trump was putting tariffs on China for something in return, whereas President Joe Biden has been putting tariffs and different type of executive orders and different type of import and export restrictions on China, but with nothing really looking to get in return from them. And I think some of it has to do with the Russia-Ukraine war. We won't go down that rabbit hole, but it's been a little bit confusing what the end game is. And so if we have a President Harris come in, she is a complete wild card. We have absolutely no idea what she would do on almost any policy, particularly as it relates to China and the U.S. I think with Trump, we kind of know what to expect there. There's going to be some bluster. There's going to be probably some tariffs and things put on, but there'll be some negotiations as well, which could reverse some of that. And so we are in uncharted territory, needless to say. I mean, you could have a whole China-U.S. relations channel coming up, no matter who wins the election, because that'll be very interesting. So you see China as a percentage total of this company's business. It's big. It's 32%. Other than that, it's diversified. And so certainly even despite the executive orders, some of the import-export controls that the current administration here in the United States, and even in China too, from a retaliatory perspective, hasn't hurt AMAT that much, but it's just something to keep in mind with this company. I probably wouldn't want to be mega overweight this one as we move into an election cycle where literally both candidates, you have very little idea where we're going to be sitting a year from now as it relates to China-U.S. relations. You literally have almost no idea. We'll get back to Nvidia, but you've had we're talking a beautiful technical bounce off the bottom. You are now in the middle of the channel of the SOXX ETF, SOXX. This is your broad-based ETF. If you don't want to pick winners and losers in the semiconductor space, or let's assume some of you have exposure to Nvidia. You might have some AMD. You might have Qualcomm, Broadcom. You have some individual exposure to that, and you want to go even more overweight the semiconductor industry because you just believe, and probably correctly, that we're in for a multi-year kind of upgrade cycle, and it's going to just benefit all the memory company, all of these companies. So the way to get overweight, in my opinion, instead of adding more Broadcom, adding more Nvidia, just add one of these broad-based ETFs, and that would be the SOXX ETF. Probably wouldn't do it here. We're in the middle of the channel. You move closer to the top of the channel. This is when I would trim. If you're overweight, instead of selling your Nvidia and Qualcomm and Broadcom, Instead of selling those, you trim the ETF. So you realize some profits. And then when you make your return to the bottom of the channel, that's when you come and buy some more. Similar story with the SMH. We've bounced off really a middle of the channel. That's why we tend to divide these channels in the middle. You tend to find support and resistance for these things in the middle of the channel. We're bouncing there. We're moving back, probably going to make a new higher high. You might even do it next week, believe it or not. Based on NVIDIA's results. Now, speaking of NVIDIA, I'm on hotel Wi-Fi, as you can tell. Pacific Ocean is actually right behind me. We've gone coast to coast here at Equity Empire over the past week. Lower highs on this one, but none of that means anything. You're more or less setting up at the highs. I mean, this is just $10 basically from setting up at the highs. NVIDIA, I think if they do what we talked about at the beginning of the show, where they easily beat expectations. I mean, the expectations of $28 billion would be if they meet those expectations, it would be an absolute disappointment, and I think shares would go lower. But I think, as I outlined, this company is going to do well north of $30 billion or right around $30 billion in the most upcoming quarter. And for the guidance, they've got to come closer to probably $33, $34 billion. And if they do that, I think you make a new high on NVIDIA up at 150. If things go terribly wrong for the company, you've got buying opportunities back at 100, although that is a support resistance area. Anything lower than that, you're certainly looking for buying opportunities. For AMD, it's butted its head up against a very logical resistance area. They were all-time highs back here in November of 2021, right about $150. You are making a series of lower highs on this one, so the path of least resistance, at least in the shorter term, is actually lower. You move lower on AMD, you're looking to buy that one as their number one competitor, is obviously floundering, as we outlined on today's show. Broadcom, I thought reported earnings this week, but I think they have a VMware conference in Las Vegas, and so that probably delayed that into next week. So we actually won't hear from Broadcom until Thursday, September 5th. So we got a week to go with Broadcom, but they'll move largely in tandem with NVIDIA. They're also making almost the exact same technical pattern, lower highs, but you're just $10 or $15 off of these highs that you made back in June. You get a good report from NVIDIA. That one will probably retest those levels. The stock that... Is this candle real? No, there's a gap in the chart. If you put this on a weekly chart, you get a solid red candle there. It's taking a while for this chart to load because it's so ugly, and my internet is like, I don't really want to look at Intel's chart. We'll look at it from a weekly perspective. There is a buying opportunity down here at about $20. We do have a green box, believe it or not, on this one. It's been on there a while. In this, and now we're at the top of the green box where I'm not wildly excited, at least fundamentally. And again, we're talking technically from Intel. Some people are like, oh, well, you're talking out of both sides of your mouth. Well, that's why when I start this, it's the technical segment of the show. Fundamentally, if you gave me Intel shares, I would sell them. Okay, like if I was an employee and I was granted shares of Intel, I would immediately hit the sell button and get rid of them. But technically, okay, there should be some support here at 20. I mean, God forbid if there's not support here at 20, we're down at 11 like tomorrow. But, technically you can play the bounce. But because the fundamentals, I got to stress this, because the fundamentals are so bad, you have to take profits. Don't turn a technical trade in Intel, and almost everybody does this, okay? They turn a technical trade into a fundamental buy and hold. I've seen it so many times. A lot of these YouTube gurus, even some of the people I worked in the newsletter business, I mean, these guys are morons. They literally turn a technical trade, a technical bounce, into a fundamental long position. And so you can't do that. You have to have a stop loss. You have to have a target price. With Intel, I could see you getting back into the $24 range. That would be a cool 20% jump on this one. And I would take that and absolutely run, because especially before they report their next earnings, which can't be good. Qualcomm, looking beautiful. One of the most beautiful charts that we actually have here. In fact, might be the most beautiful chart. Just confirmed another higher high. So this is beautiful. Come back down. You probably should find support at we'll call that maybe like closer to 120, 125. That would be a great buying opportunity. Anything lower than that, and you're like a poker player and you're pushing your chips in on this one. Taiwan Semiconductor will probably move in high correlation with Nvidia, looking very similar, very close to all-time highs. Nvidia reports great earnings and moves higher. If Nvidia somehow misses, which I think would be unfathomable. Well, you've got buying opportunities lower. ASML found support at the middle of the channel, which is dissected by this beautiful lime green line. We're moving higher. Wouldn't surprise me if this one gets back. Is that right? Yeah, $1,200 per share. Probably coming for ASML, especially if you get good earnings from Nvidia. NXP is just really consistently churning up this line. This is one of these ones that you could, I wouldn't add it here, but you're pretty darn close. ARM Holdings, one of the newer companies in this segment, found support right here, about $100 per share, bounced up. I would say this purple uptrend line, is still kind of intact. Solid earnings from Nvidia. I don't know if you could retest highs, go from 130 to 180, but the stock has been bouncing around. Pullbacks in ARM certainly look like they can be bought. SMCI needs a big report out of Nvidia. Get a big report out of Nvidia. SMCI probably could retest areas up here at 720. We didn't talk about it on today's show, but I think DELL reports their earnings next week. That will certainly impact SMCI to a certain degree. A whiff by Nvidia, and oh my goodness, you would not want to be holding this stock. If Nvidia collapses, SMCI will collapse like by a magnitude of 2 or 3 times more than that. So you would not want to see that. If you hold SMCI, you are going to reach overhead resistance. So if you're in this one and you're scared, everybody that holds SMCI, there's like nobody that's like super confident in this one. I just go by the comments and what I see online, and certainly the comments on my videos. I've been harsh on this stock. Like everybody's like on thin ice with this stock. A pushback to 725. That's your time to trim off your position to where you're not nervous. Because there's like stocks should not make you nervous and stressful. If they are, you're going way too far from an allocation perspective. So here's your chance. Back up into the 720s. That's your time to trim with SMCI. Similar to DELL. DELL's in kind of a similar technical pattern. It's actually setting right up at resistance. The company does report earnings. I think I might have to slip this over to like a daily view in order to get that. Yeah, so we get earnings on this one on Thursday. So the day after Nvidia on the 29th. We'll cover that also on next week's show. Micron found support at the middle of the channel. That's why we divide these channels in two. You tend to find support resistance here. Certainly we did. Bounced off kind of that $92 level. We're sitting at 100. This one probably still is technically a buy, although I would wait until after Nvidia reports their earnings. We've got Lam Research. This one's really close to a technical buy. Let's see when this company reports their earnings. Looks like not until about October timeframe on this one, as I think we did just a recap of this earnings more recently. This one's setting up in an area where if you felt like adding to it, you possibly could. Now, finally, Applied Materials, company that we talked about from an earnings perspective on today's show. Still, in my opinion, probably too far above kind of the overhead trend line. You could even bump this trend line up a little bit if you wanted to, have it hug the trend a little bit more. Still think you'd want to see this get down into like the 160s, 170s, at least in the shorter term, for that to be a smoking hot buy. This would be an area where I would just continue to watch this one and wait for lower prices. Folks, that was the Semiconductor Show. Like I said, on Wednesday, tentatively, we are launching our new website. We will have newsletters. I've been writing a few. Those are going to be exciting. We're going to have more content here on this channel and other places as well. Look forward to bringing that to you guys here soon. Thank you for your support. Don't forget to hit the subscribe button. The like button really helps. All of those things help the channel, and very soon we'll have other ways to consume the content. Thanks for all of your support. Thank you for putting up with my travel schedule. Well, that is all getting back to normal, and we will have a regular schedule here on the channel going forward. Thanks for tuning in today. Have a great week and a fun week as we've got Nvidia earnings, and we'll recap them next week. Until then, good luck with your investments.